Whenever we talk about the AI revolution, the conversation almost always starts in the exact same place.
Right, it's the chips.
Yeah, it's the chips, it's NVIDIA, it's the GPUs, it's all that code living in the cloud. We tend to visualize AI as this sort of ethereal digital brain just floating somewhere in the ether, completely disconnected from the physical world.
Which is the standard Silicon Valley narrative.
Yeah,
I mean, software eats the world, right? Everything is just bits and bytes.
exactly. But what if I told you that the single biggest bottleneck for AI right now isn't silicon at all? It's not how fast the chips are or how smart the model is. It's whether or not you can actually plug the thing into a wall socket without completely melting down the local power grid.
And that is the absolute physical reality check that is hitting the tech world right now. You can have the smartest algorithm in human history, but if you don't have the electrons to run it, it's just expensive code sitting on a dark server. We are literally seeing the collision of the digital world with the laws of physics.
And that collision brings us to the subject of today's deep dive. We are unpacking the Q4 2025 earnings report from NRG Energy, which just dropped this morning. Today is February 24th, 2026.
And I know if you think a utility company earnings report sounds dry, you really need to look closer. Because NRG isn't acting like a traditional utility anymore. They are positioning themselves as the critical infrastructure partner for what they are calling the AI supercycle.
Yeah, it's fascinating. We've gone through all the source material for this deep dive. So we've got the press release, a full transcript from the earnings call featuring outgoing CEO Larry Coben and the whole investor presentation deck. And our mission today is to really figure out how a legacy power company pivots to become essentially a tech growth stock.
It's a massive pivot.
It is. They are making some really bold promises here, doubling their generation fleet, promising massive shareholder returns, all while navigating a leadership transition. So we're going to see if they can actually pull this off.
It's a bold strategy for sure. I mean, it's basically betting the farm on the idea that data needs power, and they are the ones who have the power.
So let's start with the scorecard. 2025 is in the books. How did they perform? Because before we get to the fancy AI stuff, they have to prove they can run the business they already have right.
In a word, exceptional. They didn't just meet expectations, they crushed them. And this is really important because they had already raised their own guidance throughout the year. So it's a classic beat and raise scenario.
Let's look at those headline numbers. Adjusted EPS. So earnings per share came in at $8.24. Now, for context for you listening, the street consensus was significantly lower than that.
Right. And adjusted EBITDA hit $4.087 billion. But the number I really want to focus on, and this is the nugget for anyone tracking cash flow, is the free cash flow before growth.
FCFBG.
Exactly. This is the actual cash the business generates from operations before they spend money on new fancy projects. That number was $2.21 billion.
That is a serious war chest. But what really struck me in the transcript was the consistency. Management made a very specific point of saying this is the third year in a row that they've increased their outlook and then delivered above it.
And that consistency is exactly the product they're selling to investors. In the energy sector, volatility is the enemy. If you can prove that you have a firm handle on your operations, you get a premium valuation. And speaking of operations, there was a specific stress test in Q4 that really proves their mettle.
Oh, you're talking about winter storm, Fern.
I am. If you follow the Texas Grid e-cart, winter storms are the absolute boogeyman. We've seen grids fail spectacularly before. But during Storm Fern, while the rest of the grid was struggling, NRG's fleet had 97% availability.
97% seems almost suspiciously high for a stressed grid. How do they manage that when everybody else is freezing up?
It really comes down to winterization.
Yeah.
After the disasters a few years ago, NRG just poured money into insulating pipes, adding heating elements, ensuring their whole supply was locked in. It's unsexy, boring maintenance work, but when the temperature drops, that 97% availability means they're the ones selling power at premium prices while everyone else is offline.
So reliability isn't just a safety thing, it's a massive arbitrage opportunity.
Precisely.
When everyone else is struggling, that reliability becomes the most valuable commodity in the market.
It validates their operational excellence. They aren't just talking about keeping the lights on. They are executing on it when it matters the absolute most.
Okay, so the base business is rock solid. They can keep the lights on. But the real headline, the thing that fundamentally changes the DNA of this entire company, is the massive acquisition that closed just last month in January 2026, the LS Power deal.
This is the strategic pivot. This is the moment NRG went from being a large player to a truly massive one.
The scale is honestly hard to wrap your head around. They essentially doubled their generation fleet overnight. They are now sitting on approximately 25 gigawatts of power.
Wow.
And just to put that in perspective for you listening, 1 gigawatt can power roughly 750,000 homes. So we are talking about enough power for nearly 19 million homes.
It's a staggering amount of energy, but you have to look at what kind of energy it is. The composition of that fleet is now over 75% natural gas.
And I have to play devil's advocate here for a second. We are in 2026. The entire world is screaming about decarbonization, wind, solar, green hydrogen. Why on earth would a company double down on natural gas? Isn't that just investing in the past?
It feels counterintuitive, right?
Right.
But if you look at the physical realities of the grid, it's actually the most pragmatic move they could possibly make. We are in an era of intermittent renewables. Solar is great, but the sun sets. Wind is cheap, but it stops blowing.
And data centers do not sleep.
Exactly. A hyperscale data center training a massive AI model needs 5 nines of reliability. That's 99.999% uptime. You cannot run a data center solely on intermittent power without massive battery backups, which are still incredibly expensive.
Right.
You need dispatchable power. That's the industry term for power we can turn on whenever we want. Right now, natural gas is really the only scalable way to provide that backstop.
So by buying LS Power, they basically just bought the backup generator for the internet.
That is a great way to put it. They bought the reliability insurance that the tech giants desperately need right now. And management noted on the call that the integration of these assets is already beating their underwriting assumptions. They are seeing stronger capacity and energy prices than they even expected.
There was another technical term they threw around regarding this new fleet. They identified 1 gigawatt of uprate potential. Can you translate that for us?
This is fascinating low-hanging fruit. Uprating essentially means upgrading an existing power plant to produce more electricity rather than building a new one from scratch.
How does that work?
For example, you take a peaker unit, which is a plant that only runs occasionally during high demand, and you convert it to a combined cycle unit, which uses the waste heat to generate even more power.
So it's about efficiency.
It's efficiency, but it's also about speed. Permitting a new power plant can take years of regulatory hell. Uprating an existing plant, well, you already have the permit, you have the land, you have the transmission lines, you just swap out the hardware. It's faster, cheaper, and offers a much higher return. It's essentially found power hidden within their own portfolio.
Okay, so they have the power, 25 gigawatts of it. Now, who are they actually selling it to? And this brings us to the absolute buzzword of this entire earnings call, the power demand supercycle.
Yes. This is where the narrative completely shifts from standard utility company to pure AI infrastructure play.
We all know data centers are hungry, but NRG seems to have a very specific, almost aggressive strategy for dealing with them. They're calling it Bring Your Own Power, or BYOP.
I love this concept because it solves a massive political and economic problem that's been brewing in the U.S. for a few years now.
Break that down. What exactly is the problem?
Okay, imagine a massive new data center moves into your town. It consumes as much electricity as 50,000 homes combined. If they just plug into the existing public grid, they suck up all the available capacity. That forces the local utility to buy expensive emergency power on the open market. And guess who ends up paying for that?
Me, the residential customer. My bill goes up just because Google or Amazon decided to move in next door.
Exactly. It shifts the inflation directly to the ratepayer, and that creates massive political backlash. NRG's Bring Your Own Power stance is effectively saying no. If you are a new large load like a hyperscaler AI company, you have to contract directly for the generation that supports you. You have to pay for your own plant.
So if a tech giant wants to build a gigawatt-scale campus, they have to sign a direct contract with NRG to build or reserve a specific plant just for them. They cannot just lean on the public grid.
Correct. It's almost like a co-location model. The data center and the power plant are legally and financially tied together. This protects the grid reliability for everyone else, and it protects the homeowner's wallet. It insulates the public from big tech's energy appetite.
And for NRG, the opportunity here sounds absolutely massive. They stated they can support over 6 gigawatts of these long-term data center power agreements.
The financial impact of that is eye-watering. They estimated that fully utilizing that 6-gigawatt pipeline could add more than $2.5 billion of recurring annual adjusted EBITDA.
$2.5 billion, just from data centers. That's more than half of their current total EBITDA.
Yes, it is. And the quality of that revenue is completely different. These aren't your typical month-to-month utility bills. We are talking about 10 to 20-year contracts with investment-grade counterparties.
Which is corporate speak for companies that definitely have the cash to pay the bill.
The hyperscalers. The Amazons, Google, Meta, Microsoft. They're the only ones with the balance sheets to sign a 20-year power contract worth billions of dollars. It effectively turns NRG into a landlord for energy.
Now, they threw out a very specific target for 2026. Management is targeting at least 1 gigawatt of signed long-term data center contracts this year. But, and here is where it gets really interesting for the stock watchers, is that potential upside included in their current financial guidance.
No, it's not. And that's the real aha moment for investors here. Their reaffirmed guidance for 2026 implies really strong performance without signing a single data center deal. If they sign that 1 gigawatt deal, that is pure upside. It's just icing on the cake.
So the stock is currently priced for a good year based on the legacy business, but if the AI deals actually land, it immediately becomes a great year.
That's the option value. You're buying the utility and you're getting the AI call option basically for free. It's a very compelling risk-reward setup.
Let's pivot slightly because we've been talking about massive gas turbines and giant data centers, heavy metal infrastructure. But NRG is also playing a really interesting game with the smallest devices inside our own homes.
The virtual power plant,
Yeah.
or VPP.
This always sounds like pure sci-fi to me. Virtual power. Unpack this for us. How exactly does my thermostat become a power plant?
It's actually very grounded in simple economics. Think about a severe heat wave in Texas. Everyone gets home and turns on their AC at 5 p.m. Demand spikes massively. NRG could turn on a very expensive physical gas peaker plant to meet that sudden demand, or they could use software to send a signal to 100,000 smart thermostats to just turn the temperature up by 2 degrees for 1 single hour.
So reducing demand is mathematically the exact same thing as increasing supply.
Exactly. The industry calls it a negawatt. A watt you don't use is just as valuable to the grid as a watt you generate, and it's infinitely cheaper to produce. NRG's Texas residential VPP is scaling incredibly fast right now. They finished 2025 at nearly 10 times their original objective.
10 times growth. That is wild.
It is. They are building a 1 gigawatt VPP in Texas. That's the size of a nuclear reactor, but it's made entirely out of distributed residential smart devices. And now, thanks to the LS Power deal, they own a company called C-Power.
Right. C-Power, where do they fit into this mix?
C-Power does the exact same thing, but for commercial and industrial clients. It's called demand response. So now NRG has the full stack. They can dial power up with their massive physical gas fleet, or they can dial demand down with C-Power and the residential VPPs.
They are playing both sides of the equation. That feels like an incredibly powerful position to be in, just complete control of the grid's volatility.
It creates a massive moat around their business. It's very hard for any competitor to replicate that specific mix of heavy physical assets and distributed digital assets. It allows them to optimize margins in a way that pure-play utilities just can't match.
But let's talk about the shareholders for a minute. I'm listening to this and I'm thinking, okay, great strategy, but show me the money. They made a pretty bold promise about 14% growth.
They did. They reaffirmed a long-term target of at least 14% annual growth in adjusted EPS and free cash flow per share all the way through 2030.
14% compounded for 5 years is serious growth for a company of this size. How are they funding that? Are they taking on massive debt?
No, and that's the beauty of their cash flow machine. They have this massive war chest. They estimated their total capital available for allocation through 2030 at $18.3 billion.
That is a lot of dry powder.
And here is the plan. They plan to return $13.2 billion of that directly to shareholders. That breaks down to about $11 billion in share repurchases, so buybacks, and $2.2 billion in dividends.
So they're buying back their own stock very aggressively.
Aggressively, but with strict discipline. And this is key. CFO Bruce Chung made a point that I think is crucial for investors to understand. He emphasized a very strict hurdle rate.
The hurdle rate. Explain why that matters so much here.
Well, in the past, utilities were famous for empire building. They would build massive new plants just to get bigger, even if the actual financial returns were mediocre. NRG is saying we will only invest in a new project like a data center power plant if the return exceeds a 12 to 15% unlevered hurdle rate and beats the return of simply buying back our own stock.
So if building a data center plant returns 10%, but buying back NRG stock returns 14%?
They buy the stock. They
Yeah.
absolutely will not chase growth just for growth's sake. If the deal doesn't hit that strict number, they walk away and just pay the shareholders.
That imposes a level of financial discipline that is actually quite rare in this sector. It completely prevents them from getting caught up in the AI hype and overspending.
Exactly. It keeps them honest. It aligns management's incentives perfectly with the shareholders.
Speaking of building, though, they are actually pouring concrete in Texas right now. This isn't all just theoretical buybacks and software.
No, the Texas Energy Fund, or TF, is in full swing. NRG isn't just buying old plants. They secured loans for 1.5 gigawatts of brand new capacity across 3 different projects in Texas.
And these aren't just standard market rate bank loans
Correct.
from.
These are heavily supported, low-interest loans from the state of Texas. The state is terrified of the grid failing again, so they're actively subsidizing the construction of new gas plants. This mitigates the financial risk for NRG substantially.
When do these new plants actually come online?
Fast. The first project, which is TH Wharton, is on track for completion in June 2026. That's literally just a few months away.
In the utility world, that is light speed. Usually these heavy infrastructure things take 5 to 10 years.
It really shows how urgent the demand is in Texas.
Mm.
The other 2 projects are expected by mid-2028. So they are adding new modern steel to the ground to support the Texas grid, and the state is helping them pay for it.
Okay, so we have the numbers, the strategy, the massive AI pivot, and the real-world construction projects. But we also have a changing of the guard at the top. This was CEO Larry Coben's final earnings call.
It was. He is moving to an advisor and board role. And the new CEO, the successor, is Rob Gaudette, who is currently the president.
Did you get a sense of the dynamic there on the call? Sometimes these executive transitions can be rocky, or the new guy wants to completely undo everything the old guy did.
This felt very seamless. Rob Gaudette was heavily present on the call, and he was actually the one answering all the deep dive Q&A regarding the data center strategy. He clearly already owns that part of the portfolio.
So Coben basically built the foundation, the reliability, the balance sheet strength. And Gaudette is the one who is going to commercialize it for this new AI era.
That definitely seems to be the play. Coben's parting tone was really telling. He literally stated, "The best is yet to come," citing the reshaped portfolio. He seemed to genuinely believe he's handing over the keys to a Ferrari that's just been warmed up. He spoke about how the balance sheet strength they've achieved over the last 27 months basically sets them up perfectly for this exact moment.
It's a really compelling picture. If we zoom out, NRG has transformed from this sort of boring standard utility play into a true hybrid monster.
It really is a hybrid. On
Right.
one side, you have a massive natural gas backbone that is boring, reliable, and cash generating. On the other side, you have this high-growth tech stock attached directly to the AI boom.
And they're using the cash from the boring side to fund the growth on the tech side and then buying back stock with whatever is left over. It's a perfect self-reinforcing loop.
It is. They've positioned themselves as the ultimate gatekeepers of the one thing AI needs, even more than data: energy.
Which brings us to a really provocative thought to end on today. We talked heavily about the bring your own power model.
Right.
If NRG really succeeds with this and we see Microsoft, Google, Amazon signing these massive 20-year contracts for their own dedicated power plants, are we moving toward a fundamentally two-tiered energy system?
That is the big societal question we have to ask, isn't it?
Yeah.
Imagine a future where big tech essentially becomes its own private utility, backed by partners like NRG. They have gigawatts of reliable, dedicated power that is completely independent of the public grid the rest of us rely on.
So while we are being asked to turn up our thermostats to save the grid during a heat wave, the data center right next door is running at a cool 68 degrees because they brought their own power plant.
It changes the energy landscape for everyone in 10 years. It protects the public grid from collapsing under the weight of AI.
Yeah.
But it also creates a parallel infrastructure where the wealthiest companies on Earth have true energy sovereignty.
Yeah.
They aren't reliant on the state or the public anymore.
Energy sovereignty, that is a heavy concept. It's almost like the privatization of reliability.
It really is. And for you listening, watch for that 1 gigawatt signed contract announcement in 2026. That will be the proof of concept. If that ink dries, this two-tiered future is officially here.
Definitely something for you to mull over the next time you ask an AI chatbot a question. It takes a massive amount of natural gas to generate that answer, and very soon, that gas might be coming from a private plant owned effectively by the algorithm itself. That's it for this deep dive into NRG Energy. Thanks for joining us.
Talk to you next time.